Welcome to Financial Planning Explained. I'm your host, Mike Menninger, certified financial planner, owner and founder of Menninger Associates Financial Planning. Happy to be joined here by Ryan Keefe, who's one of my associates, also a CFP. Thank you for joining me, Ryan.
Thank you.
So this is the fourth part in a series of the various areas of financial planning, but most notably, what we did is we actually scoured good old friendly artificial intelligence.
Yeah.
It's actually starting to serve its I was like, what am I ever going to use AI for? Well, what we did is very simply, we just said, hey, AI, give us a list of questions that are commonly asked by the general public as it pertains to financial planning. Then what we did is we sorted it to subject material. And so this is the fourth part in the series. In the first part, we talked about just general financial planning, which led into retirement planning, because a lot of those questions led into it. And then we did the previous episode also with you. We did debt management. And so the next one is going to be on insurance planning and risk management. And then in the subsequent episodes, we're going to be talking about investment planning and tax planning. So with no further ado, let's jump into the questions. You ready to go?
Yeah, let's do it.
All right, cool. So I'm going to read the questions that were presented. And the first one was, how much life insurance do I need? It's a great question. It's asked of us a lot. You want to grab it?
Yeah, sure. So the answer to a lot of financial planning questions, and we always like to joke about it, it depends. It depends on a number of factors. One thing I always will tell clients, better to be overinsured than underinsured. The last thing you want is something catastrophic to happen and you don't have the insurance behind you to fill in that void.
Right. Well, you say it's better to be overinsured. No one has ever said, oh, shucks, that's too much insurance.
Yeah, exactly. But there's a lot of factors that go into it, such as do you need an income replacement? Do you need to have debts paid off if you were to untimely pass away or become disabled?
Funding.
These are life insurance. Sorry.
Funding goals, such as I want to be able to set aside $100,000 or $200,000 per child for education, pay off the mortgage, pay off debts.
Yeah.
That's going basically the two different methods of identifying are the capital method, meaning how much money do I need to pay off, and then the income method is how much money do I need to set aside to provide the income that's being replaced.
Correct.
So it's basically what you're saying.
Yeah, in a lot shorter way.
So one of the things that I've used most notably is I use a combination of the two. And a mortgage is a good example. You pay off the house. Well, how much does your payment go, your monthly cost of living go down? Mm-hmm. So really, if you take a look at it and say, if you're going to lose a spouse, you look at that particular person, what is the income that is being generated by that person that you have to replace? Now, one thing that's hidden is the person who passes away was contributing to a retirement account, probably.
Probably.
Okay, so you got to take that into consideration. But, let's say you have someone who's taken home $6,000 a month. Well, how much money do you need to have set aside to produce $6,000 a month? Well, arguably, if you're earning, let's say 5%, what is that? It's over $1 million. It's $1.2 million.
Mm-hmm.
Okay, actually 6% a month is $72,000 a year, which is a couple $1 million worth of insurance. That's a lot.
Yeah.
The reality of it is, do you need to replace the whole 6,000?
And probably not.
Right, because out of that 6,000, 2,000 of it might have been the mortgage. You pay off the house, and guess what? That 6,000 becomes 4.
Right, and you're also accounting for now you're just paying for one instead of for two.
Correct.
Or at least one less member of the household.
Correct. So one of the things that people may fail to look at is Social Security. Social Security provides a benefit to a surviving spouse if there are children, as well as provides a benefit to the children. So it'll pay a benefit on a monthly basis to a surviving spouse until the youngest child turns 16, and it'll pay each child a benefit up until they turn 18 as well. So, that could provide a pretty reasonably decent benefit.
Yeah, absolutely. And I think I know we did a few episodes on insurance planning before. But one thing I always like to point out to people is, you want to know how much insurance you really have. A lot of people, you ask, oh, do you have life insurance? Are you covered? And they're like, I got something through work. and they don't even know, is it 2 times salary? Is it, can you buy more? Do you have, the opportunity to go with, private insurance and it's actually cheaper?
Yep.
Or if sometimes you're not even really that insurable, but you can be insured through your work policy and you can always buy up to more, depending on, when open enrollment is and things like that.
Yeah, that's the downside, because then you're limited to only increasing or decreasing your insurance at open enrollment. And then if you happen to leave that particular job, well, then you're out of luck. So as a general rule, if you are equal to or better than the average of your age demographic, you're better served getting the insurance on the outside and privately. And the other thing to take into consideration is, how long you need the insurance for.
Right. Yeah, exactly.
It's income replacement, which when you no longer have income, you probably don't need the insurance any longer.
Yeah, correct. And by that time, you probably have built up your assets to a point that you can kind of self-insure yourself.
Correct. So again, to Ryan's point, we did have an episode on the how much life insurance should I get, and we went into that in greater detail. So the next question is also, again, what is the difference between term insurance and whole life insurance? You want to grab that one as well?
Sure. So let's start with term. So term insurance, I think it says in the name, covers you for a defined period of time or term. It's pretty simplistic in that if you die within that given term, your death benefit goes to your beneficiaries. It's usually very it's relatively cheap compared to other kinds of insurance, but that's really the only value that it has, aside from the death benefit. When it comes to whole life insurance, that's where you're covering yourself essentially for your entire life up to age 100. Where if you make it to age 100, woohoo, you get the death benefit. But whole life is generally more expensive and has an investment component behind it in the form of cash value. You can attach different riders and things to it. It's a little more gimmicky, I would say, than term insurance, but it does have its place for those certain people that could use it.
Right. And so whole life is a common term like a Kleenex, but it's a tissue, right? Well, whole life is the term that they use for any life insurance that builds cash value, when in fact, really, you get the whole life. You have whole life, which by definition is whole life, which is the first type of policy. But then they later came out with universal life, which is, instead of whole life trying to build a cash value, and it's based on building cash value, universal life is the minimum amount of cash value that you need to keep the life insurance policy in place, which I found to be the most efficient for estate planning. And then you have variable universal life, where the investments, you control the investments. And then the last one now, it's a new flavor, is the index universal life, where they're using like index type of things, little gimmicky to your point. One of the things that I would say though, is as a general rule, if you're looking at the difference between term life and whole life is not the greatest investment. It may be a good investment if you've exhausted all of your other tax advantaged investments, but as a general rule, I'm not a big fan of it. Generally speaking, there are 3 parties to any insurance policy. It's the insurance company, the sales agent, and the individual who's insured, and 2 out of the 3 win every time.
Yeah. Yeah.
I'll let you decide which of the 2 or the 3. So, but they do have their place. They wouldn't have them if they didn't, but they do have their place. I'm just not a big fan of the whole life myself.
Yeah, no, me neither. And I think a lot of problems can be solved through term. But like you said, maybe somebody has a whole life policy and they become uninsurable. They get diagnosed with cancer or something.
Right.
That's where you want to make sure that policy stays in force.
That's correct. Again, I still prefer the universal life, because if you're buying it just for the life insurance, then you're paying the minimum amount towards the policy premiums. And you can get them with a guaranteed to age 100, guaranteed to age to 120. So, I mean, you pay a little bit more for that, but the premiums that you pay will always certainly be less. Next question. Do I need disability insurance? I'll take that one. Again, need is a funny word. always strongly recommended to have disability insurance. Similar to life insurance, it's an income replacement tool. The difference with life insurance and disability insurance is that if I'm disabled, I didn't die, I'm not collecting on my life insurance policy. So therefore, all those monies aren't coming in to pay down the debts and income replacement. And as a rule of thumb, your disability insurance is only going to cover you up to 60. I've seen 70%, but 60% of your income. So if you're making $100,000, well, let's say $10,000 a month. $10,000 a month is $120,000. That's a pretty good salary.
Yeah.
Well, the problem is that that's $10,000 a month. Disability insurance is probably not going to cover you for more than 60% of that. So if you're acclimated to living on $10,000 a month, you're taking a haircut by getting only 60%. And most cases, I would, and I don't have a statistic on this, but I'm going to pull a guess out of thin air that better than 90% of insurance policies or disability are through work.
Yeah.
Through your employer's benefits. Whether they pay, whether you pay, or they pay some, you pay the rest. The rule of thumb is it's capped at 60%. Why? Because if it was doing 100% of my income, what's my motivation to go back to work? Heck, if I can get 100% of my pay and sit at home eating potato chips and watching TV all day, not to say that I'd want to do that, but still. That's why they cap it, because they want there to be some level of motivation for the individual to want to go back to work. And they'll cap it at 60 or 70%. But here's where you got to be careful. A lot of people, a lot of clients of ours, if you take a look under the hood and you look closer at their insurance policy that they have through work, is it only pays based on their salary. And there's a lot of salespeople out there, or a lot of executives out there who might be making total compensation $200,000, but their base salary is like 60.
Right. Yeah.
And then the rest of it is commissions and bonuses. And typically, you got to look closely at these policies. Typically, through work, they're going to be based upon your salary. So here you're thinking that you're getting a replacement of 60% of 200,000 when you're getting 60% of 60,000. That's $3,000 a month.
Yeah, creates quite a bit of an issue.
Slight reduction in your income. The other thing that we would point out to you, let's say we're looking at the work insurance, is some employers, and I know I'm one of them, okay, allow for the participant to buy the insurance after tax. So knee-jerk reaction, because as you know, I'm extremely savvy. We are very tax savvy around here. If I was paying $100 a month for my insurance, well, hey, if you're given a choice of tax deductible or after tax deductible all day long, right?
You'd think.
Yeah, except for one thing. I will tell you that unequivocally, we always recommend that people take it after tax. Even if you're in a high income tax bracket, the reality of the situation is while you're working and making a full salary, all you're doing by after tax means that if my cost of the disability insurance is $100 a month, instead of getting a tax deduction and maybe saving $30 a month, I'm not getting a tax break.
Mm-hmm.
But what happens here? It's just like IRAs versus Roth IRAs, anything pre-tax versus post-tax. If I am now receiving my benefit, that is after tax. And if it's after tax, if I'm taking a haircut, I'm taking a 40% haircut, well, guess what? After tax, that 60% is going to be mighty close to what your paycheck was.
Right.
And therefore, your disability is not, no pun intended, crippling you.
Pretty good.
Anyway, so do you want to add something?
Yeah, just one important aspect of disability insurance that I always like to point out, it's two little three-letter words that can mean all the difference when it comes to your policy. There's any and own. With any type of disability insurance, let's say you're
any occupation.
Any occupation. Let's say there's any type of, let's say you're like a surgeon, and you get any occupation disability. If you were to injure your hands and could no longer be a surgeon, well, you could certainly, do other occupations and you would qualify for any disability. But when it comes to own, you wouldn't be able to be a surgeon.
In other words, would you like fries with that? In other words, that means I still can. I broke my hand or my hand is maimed or whatever the case may be, and I'm a surgeon. But if it's any occupation that gives me the ability to, like, I won't be covered because I could be working at McDonald's or doing something different. The surgeons are the ones who made a killing on this because they would go own occupation. They're not capable of being a surgeon. They're getting 60% of their $600,000 income, and then all of a sudden they go teach, and they're making about $300,000 or $400,000 on top of it, and now they're making a killing on it. Now, that's the long and short of it, but that's a very good point, Ryan. Thanks for bringing that up. And then to take into consideration how long the benefit is. So we always recommend for long-term disability. Short-term disability usually leads up to either 3 months or 6 months, and then it kicks into long-term disability. The long-term disability is where we believe you really ought to make sure that you're really, really well insured.
Absolutely.
Okay, so that's a good breaking point. We'll be back with you in just a few moments to pick this up from where we left off.
Do you keep up regularly with your investments? Where exactly are your hard-earned dollars going? Are you financially prepared for an emergency?
I'm Mike Menninger, founder of Menninger Associates Financial Planning. We believe that education and knowledge are powerful, and we want our clients to understand why we are making the recommendations that we make. It's your money, and you deserve to know where it's going, because it's not how much you make, it's how much you keep. So call us today to discuss your financial concerns. Welcome back to Financial Planning Explained, and we're picking up where we were talking on the different types of insurances. In the first segment, we were talking about life insurance. How much do I need? Difference between term and whole life, and then long-term disability, or shall I say disability. So let's go with the next question that was, having just read it during the break, I realized there's a lousy question. How can I make sure I have the right amount of health insurance coverage? All right. Well, I'm going to throw that question out and reword it. The right amount, really? It's not as if you can pick how much you have. It's you either get it or you don't. So let's reword the question and say, how can I make sure I have the right health insurance coverage? I'll let you take that one as well.
So I think the way to determine you have the right health insurance coverage is, you got to really assess your own health. Take a look at, do you run, do you exercise, or do you eat rather healthy, or are you on the unhealthier side of things and more at risk of having health issues where you could need medical attention? You also want to take a look at your family needs. Are you and your new spouse, expecting a child this year? Are there other, people that really depend on your medical insurance to cover them? Some spouses, my own, doesn't have any medical insurance, so she really relies on mine to be, in tip-top shape so that it covers both of us and all of our medical needs. The other thing I always want to take into consideration, is your family history. Even if you're, healthy and exercise quite often, if you have a long history of, heart attack or heart disease or strokes or anything like that, you want to take that into account every time your open enrollment comes around to make sure that you're adequately covered. And then I always, recommend that people reevaluate it annually.
Oh yeah.
A lot of people get medical insurance when they're younger and healthy, and as they get older, they just kind of keep re-upping the same health insurance. And as we get older and years go by, things change.
Absolutely. So the other thing that I would point out as it pertains to that is that the one thing that Obamacare really did is they standardized the health insurance. So if I wanted to get a particular Silver Proactive, and that's the only one I can remember thinking about, which happens to be what we have in our plan here, which happens to be the baseline for the Obamacare. But basically, it doesn't matter whether you get it from whichever insurance companies out there, Blue Cross Blue Shield, Aetna, Travelers, whoever is, I don't even remember anymore. But at the end of the day, to your point, you want to make your plan specific to you. For instance, I may take lots and lots of meds. Well, then I want to make sure that my plan has a very good prescription plan. Now, you may not take very many meds, but you may be one who goes to the doctor a lot, for a variety of things. Or to your point, you have heart disease and everything else. You're not taking any meds,
Right.
but you're seeing regularly a cardiologist and a pulmonologist and all these ologists. Okay. So what you do is you tailor your insurance policy to be what's right for you. I mean, and then if you're 23, 24 years old, you may say, hey, look, you know what? If you're anything like me, I was invincible at that age. I never went to the doctor. You just get the basic coverage. But you always want to protect yourself from a major financial disaster.
Oh, absolutely.
And that's really the purpose of the health insurance. So how do you know if it's right? Well, right for you, okay? And you get what's right for you. Next question. Ooh, I'll take this one. Should I get long-term care insurance? Wow. If there is ever a it depends answer, this is the one. Whew. Long-term care has become more and more popular from the perspective of needs for a variety of reasons. Number one is people are living longer, and it seems as though we're hearing a lot more of Alzheimer's, dementia. People are otherwise healthy but can't take care of themselves and require very much medical attention around the clock.
Yeah.
And so should I get it is a very, very difficult question and takes a very in-depth analysis. First of all, because of the likelihood of it happening and the increased costs of it happening, the premiums for buying long-term care insurance are very high. So you should take a very close look at if you have a litany of different types of incomes in retirement. Let's say I have a pension and my pension is $6,000 a month and my Social Security is $3,000 a month. That's generating $9,000 a month. Do I really need a robust long-term care policy? Probably not, because if I am in long-term care, trust me, I'm not going on vacation, okay? And I'm probably going to end up having to sell my house. So what it's really there for is to supplement what income I am already receiving to ensure that A, my spouse is not going to be having to live on hot dogs, and B, that if the care far exceeds what my baseline income is going to be, do I have the assets to cover it, or is it going to wipe out my assets that it leaves nothing for my spouse or it leaves nothing for my children, if leaving money behind for my children is important? And it then begs the question of, people may say, look, you know what? And this is the truth. People say, look, I don't want my legacy to go to the long-term care facility. And that is entirely understandable. And what you do is you say, look, let's say, for instance, the cost of long-term care insurance is $10,000 a year. Do not underestimate $10,000 a year. But if you got $1 million in assets, basically what you're doing is you're taking 1% of your assets and buying long-term care to protect your assets, so that if you went into a long-term care facility, then at least you're not going to wipe out your assets. The other thing too is having companion policies. Companion policies often are good. I have someone close who, husband and wife, they're both, I hate to use the word elderly. Hopefully they're not watching. People hate the concept that if I don't use it, it's gone. But if you have companion policies and the amount of money in one policy isn't used and it rolls over to the other person, then that's good. It kind of helps kind of improve the chances that you're not going to let it go by the wayside. More recently, they've become more common to have hybrid policies. And what a hybrid policy is basically it's a life insurance policy that also has a long-term care benefit to it. So part of the reason why it's become popular is because people hate the fact of paying premiums and never reaping a benefit from it. So if you're paying for the premiums and you die without using it, then at least your beneficiaries are getting the life insurance premiums from it, or the life insurance proceeds. So long-term care is a very, very touchy subject and really requires a lot of thought. If you don't have the money to cover the cost and you don't have the assets, then it's going to wipe out. It almost, I hate to say, it doesn't make sense to get long-term care.
Yeah.
It's really designed for the people who have a middle range of income and assets.
Yeah, absolutely.
So, and last question. Oh, this is an easy one. I'll let you take this one. All right. What role does umbrella insurance, meaning umbrella liability insurance, play in protecting my wealth?
So basically, umbrella liability insurance is it's extra liability insurance above your standard insurance is like your home and your auto insurance. It does a lot of things it covers a wider range of risks. Hence the term umbrella. It covers a large amount of risks. And basically it's there to protect your assets and home in case of lawsuits. Mostly lawsuits.
Most of
What I can
lawsuits.
think of. And it's relatively inexpensive, and you can get a pretty large amount of coverage. So it's almost one of the recommendations I generally will make to people, just if they have assets and things that they're worried about, losing in lawsuits.
Right, as do we, and we do always make this recommendation. To your point, I'm not going to quote insurance costs here, but to get $1 million umbrella policy, it's not a life insurance policy, an umbrella liability policy, it's like a couple $100 for $1 million. And typically, unless it's an extremely egregious type of lawsuit, is like a slip and fall or whatever, they're going to go after whatever your insurance company is. And your homeowner's insurance may cover $100,000, but if this is a substantially larger injury and there may be fault or anything else like that, they'll go after the umbrella liability and they'll often stop at that.
Right.
And effectively what you're doing is you're protecting your assets, which is a really good idea. Now, where do you get it from? Well, you basically get it from your property and casualty insurance company, meaning where you get your homeowner's insurance and your homeowners and automobile insurance are your property and casualty insurance companies. You got it through there. Okay. And so we strongly recommend everybody consider, it's not a lot of money, but it provides a lot of protection. And why is it not a lot of money? Because like all insurances are statistics and probability based. The odds of it happening are much lower, which means that the cost of getting the insurance is much lower. But man, I'll tell you what, peace of mind is a very valuable thing.
Oh yeah.
And just for a couple $100 a year, that's not a bad thing.
Yeah, absolutely.
So that's all we got for today's episode. Hope you learned a little bit about something about the insurances. Insurance, nobody likes to pay insurance until all of a sudden they have a need for the insurance. Similarly, as I pointed out, when it pertains to the umbrella liability, all insurances are based upon the likelihood of something happening, being probabilities and statistics, and the cost of it happening if it were to happen. Therefore, what is the most expensive insurance out there? Medical insurance. Why is medical insurance most likely? Because you're going to the doctors. The odds of you going to the hospital for breaking your finger, breaking your hand, breaking your arm, like we do all kinds of dumb things, okay, and breaking things, which I have a lot of broken bones in my body. It's all about that. So thank you very much for joining us. I hope you have a wonderful day and see you next episode.